Brian, man, I am excited to have you on the show today. I'm so amazed that we were only really one person away from knowing each other, and
Yeah,
I got a quick introduction. Man, welcome.
thank you so much. I'm super excited to be here with you guys. This is gonna be fun.
So our audience knows, like we always preach on here, the power of the network. And I was literally
Right.
listening to you on Brandon Turner's podcast 30 days ago, and I don't know how I connected, but you're in Go Abundance, and I made
Yeah.
that connection, and I texted one of my guys in my Go Pod, and I said, "Hey, anyone know this guy?" And Chad Beeman, he totally, I guess, shout out to Chad for he literally, it was a Saturday night at like 7 o'clock. He's like, I know that guy. I'll text him. And he put us on a group text like within like 10 minutes, like on a Saturday night at
Yeah.
7 night. Like this is awesome. This is the power of networking. So I just wanted, like, we preach that in here all the time. And I know that network is huge.
Yeah. Chad's a great guy. It's cool to make a connection through him. Like, again, it's like happened multiple times. So
And then, before we dive in, the other thing that I took away from your book that I loved is you played NBA Jam. I loved NBA Jam.
Oh, there we go. What was your team?
Oh, I mean the Bulls, right? You had to play the Bulls.
Good Chicago answer there.
That's
Pippen
right.
and Grant though, no Jordan.
Yeah,
Right,
yeah,
right,
there
right,
was no
right, right,
Jordan.
right.
But I always
I
loved
mean, it was so long ago.
I woke up the other night. I remember the cheat code or whatever to get turbo the whole game.
I remember Bill
Okay.
Clinton was ARK. Remember you could do like the initials to get like the cheat guys.
Yep, yep. So, well, here, Brian, jumping in here. You wrote an awesome book. Tom and I both read it. We're going to share it with the audience here in the show. We're going to talk about it. You've done some amazing things, and your mindset started as far back as you were like 17, of like understanding some of this real estate, or at least thinking you knew what you were talking about back then. Like, kind of
Right.
start from 17, like that mindset of how you ended up being where you're at today.
Yeah, so I was 16 or 17 when I first kind of was exposed to the idea of investing in real estate. And honestly, I thought it was ridiculous. I thought it was crazy. I just overheard my father and my grandfather having a conversation about buying a duplex. And I just kept thinking, why in the world would you take on the risk of getting this big, massive loan and inviting complete strangers in to pay your house? Maybe they'll pay your rent, maybe they won't. Go unclog the toilet at 11 o'clock in the morning or 11 o'clock at night, all that kind of stuff that I know a lot of people have those same thoughts. They were going through my adolescent teenage mind, and I just thought that they were crazy. And so as they were talking, I was just kind of eavesdropping and listening and just thinking they're nuts. And then they get to the point to where they're like, okay, let's call the agent and make an offer. And I felt like I was doing them a favor by like stepping in and saying, are you crazy? Why are you doing this? This doesn't make any sense. And they went from like doing a business deal to realizing that they had a teachable moment with this cocky teenager, right? And so they spent the next, I don't know, couple hours probably walking me through why they were going to do it. And when we got to the end of the conversation, I saw that their projections were they were going to triple their money in like 8 years or something like that. I was like, oh, that's why you're doing it. And they're hiring managers. They're not unclogging the toilets themselves. They're screening the tenants. So yeah, you might get a bad one once in a while, but that's all calculated into the numbers. And so they just really helped me understand the power of investing in real estate. I got a little bit older, not a lot older, but when I was 19, I was in college. I was a freshman in college, and it was time for me to go get my own place. And I just didn't want to pay rent. I didn't want to even pay my own mortgage. So I tried to figure out how can I live for free and start investing in real estate. Now, the term house hacking hadn't been invented yet. It was live in one side, rent out the other. That was the strategy, right? And so that's what I did. I bought a duplex. I rented out the one unit. I got roommates to come and live with me in my side, and it almost covered the mortgage. And the reason why I did that was one, to live for free, but number two, I recognized that almost all wealthy people that I knew they either got that way by investing in real estate, or they built wealth somewhere and they put the money in real estate. And so I thought, okay, if I just jump into real estate, things are probably going to work out. That's how sophisticated I was at the beginning.
That's all you need. But it's true.
Right.
Like we don't have to overcomplicate this.
Right. Exactly.
Your background, you didn't come from tons of money. You didn't come from doctor and lawyer parents. Like
No.
how were you raised, like in that sense?
Yeah. So my dad was a small business owner. And as with any small business, I'm sure everybody can relate. There were good years and there were bad years, right? And so there was kind of like feast and famine kind of a situation. And this period when I was like 16 or 17, where I heard this conversation, there's a little bit of a feast and had a little bit of cash to invest. Not a ton, but had a little bit of cash to invest. But I remember at that age that was the first time that I really sensed that there was a little bit of surplus around that we could do something with. So growing up, I was exposed to the idea of being an entrepreneur, running your own business, but investing, yeah, that came later in my life. So
And we'll talk more about that and how you pass that mentality on to your kids. But
right.
you bought your first property in college, or your house hacking. You continue to buy some more real estate over the next few years, correct?
Yeah. So after I bought those 2 units and I kind of figured out, okay, this is how you get a tenant, and this is how you do this, and this is how you do that. I was like, okay, well, I want to grow this portfolio because, again, everybody that I know that is wealthy has more than one property, right? And so I need to expand my portfolio. So there's no reason for it, but I was just like, I want to buy at least 1 unit every year going forward. And so I bought the next year, I bought another duplex, and the year after that, I bought another duplex. And then a couple years after that, I bought a fourplex. So I had 10 units by the time I was like 20, 23 years old. And
So
every
Brian,
single one of those deals.
real quick, sorry to interrupt, but that sounds awesome. A lot of our listeners are saying, wait, how did you do that? Right? A lot of people are stuck on, hey, I did my first house hack. I used up all my money on the down payment, the rehab, the reserves.
Yep.
Getting that next building is a tough spot for people. So just talk a little about that as a young guy, like how you were able to save up the money or partner, whatever you did to, go 0 to 10.
Yeah, so I didn't have any money for rehab. So my very first duplex was a brand new build. I just bought it, moved in. The second one didn't really need anything more, maybe carpet, paint, or something like that. So I never did significant remodels. I would just buy the property off the MLS and I would move in. And every single one of those was some creative, weird way that I got in because I didn't have any money. My first duplex, I only put $2,500 of my own money in. I guess, I don't know if it was an FHA loan, but it was a really low down payment loan that I got into it. It was only $120,000. This is 1996. So money has lost a little bit of its value in that time frame. But so I paid $2,500 for that first one. The second one, I actually borrowed the down payment from my grandfather. So I borrowed, I think it was $10,000. I paid 10% down on the second duplex. The third duplex, I made a deal with the seller where he carried back the down payment. So I just got the loan, maybe a 90% loan probably. And then he carried the 10% down payment. And I actually worked for him and paid that off that way. And then the fourplex, I think finally I got to the fourplex, I did have enough money to make the down payment, I guess, because we didn't really do a creative strategy on that one. So, but every single one, I was like, I need to get my units for this year. So I got to figure out how to do it. So that's how I attacked it.
That's awesome. It's, even people might scoff at them like, oh, well, it's $100,000. It's different in Chicago, but the principles are still the same, right?
Yeah,
the idea
but
of
in
having to be creative,
1996,
having to get
baby,
scrappy.
Yeah, I mean, realize that was 1996 through 2001. So different world economically. And yes, I understand prices are different now, but those same buildings that I bought then now are, I mean, the duplex is going to be 600 grand, right? The same duplex I bought in 1996. So just kind of use that as a reference.
Yeah, no, that's awesome. All right, so you get up to the fourplex, and I'm assuming at this time, are you working a W-2 job at all? You've been an entrepreneur at heart. Were you still, collecting the pay stub at the young age just to have that income?
Yep, I was making, I think, 50 grand or something like that by the time I got to my fourplex. Yeah.
Okay, so another important one too. You don't just drop out of college and say, "Hey, real estate's this magic ticket for me."
No, I mean, I wasn't solely reliant on my real estate for my income until I was 44 years old. So yeah.
Yeah.
What were you thinking though in the young 20s though about what 44-year-old Brian looks like or his life? Were you looking for, a lot of people use the financial freedom word, or were you thinking?
I was gonna say Brian doesn't look 44 right now, man. You look great.
Yeah.
Thank you. Thank you. Oh man, you're so kind. So the question was, when I was in my 20s, what was I hoping for my 40s?
Yeah, what was your vision, I guess, of you're doing all these things, but what were you thinking? Because a lot of people, I'd love to see where that lines up.
Yeah, just to kind of really be honest and humble a little bit, I didn't have a grand plan. I just knew I mean, my plan was as sophisticated as I'm going to add a unit every year, on average, forever. And I knew of a guy that had 100 single family homes in Boise, which is where I was born and raised, had 100 single family homes. And I thought, I'm gonna try to get to 100 units. I mean, I can't wait 100 years to get there, so I'll have to step on the pedal at some point, but I'd love to have 100 units. And
I love
that's
that.
as sophisticated as I was.
Yeah, I think that's an okay. So I think that's okay. You don't always necessarily have to have a plan. Is probably
Right.
the point to be taken there. You just have to keep doing things that are moving in the right direction. The right direction is
Right.
probably the key word, and a lot of times you'll create your own luck, which you go into. We'll talk about here more today.
Yeah.
Yep.
Right.
Give us some of the setbacks there, right? It sounds great to talk about now, but there had to have been a few sleepless nights. There had to be a few things that like, oh my God, is this the right thing for me? Can you share some of those with our listeners? Because there's people listening to this going through those moments right now.
Yeah. I think it's really important for new investors, or even investors that have gotten that first one and they're thinking about getting the next one, to understand that I don't know if every investor is like this, but every single time I buy an investment, especially a multi hundreds of thousands of dollars like a home, I am nervous and I feel the question comes in my mind, this could go horribly wrong. You know, am I making a mistake? Should I do this? That happens every single time. And I think that is a healthy balance to the aggressive side of us, where we're like, yeah, let's just add units and not think about it. And I think that's a healthy balance that we have to have. In fact, I say that if I ever get into a transaction where I don't have that kind of like that doubt emotion, that's probably going to spook me more than the doubt. But like, I'm getting too complacent, I'm getting too comfortable, I'm not looking at this close enough. And I will also say that when I go back and look at those early deals that I did, where I was like not sleeping before signing the papers. I remember signing the very first document. I was like, why am I doing this? I'm putting $100,000 on my name here. This is crazy. And now I look back on that, I wish I'd have figured out how to do 10 or 100 of those things, because it was so lucrative, right? And every single time down the road, the fear that I had was overblown, right? Not that I haven't made some mistakes. I've made some mistakes. I've paid some dues. But even on those, you get at least a lesson out of it, right? And so it has some value there. So I would just say that emotion is normal, and you need to listen to it. And if you think that you are getting yourself into a situation that you're not qualified for, reach out to somebody who you know who is, and walk and talk through the deal with them. But assuming you've done good due diligence, I would encourage you to push through, because real estate is so forgiving. Time in real estate, you don't have to be a rocket scientist in order to be successful. You just need time and patience and buy the right deal.
Tom, you gonna drop your slogan there?
That's it, baby. Time is your biggest
Well,
asset.
Yeah, for sure.
We need
Yep.
shirts made.
Yep.
We're getting shirts made that
That's
say
it.
time is your biggest asset. And then we also need shirts saying friend of the pod for all the friends of the podcast.
Yeah, yeah.
Those
That's
two
awesome,
are on my
man.
to-do list. So
That's awesome.
Brian, that's great advice. So let's jump into the book, because a lot of this that we're talking about will kind of come out anecdotally, because that's kind of how you
Sure.
wrote this thing. So the book, we keep referencing it. It's the Hacker Method. I'll hold up a copy for everyone to see right here.
Yeah,
I
got a
will link to
copy.
it in the show notes. Yeah, you got it too. We're ready to roll.
Man, I didn't have my copy because I gave it to one guy in my office. He read it. He gave back. I gave it to the second guy. So we're on 3 people that one book
I
already.
love that.
It
That's
doesn't help your
that's like the
sales,
best
but
thing in
people
the
are
world.
reading it though.
Yeah, right. Hey, that's okay. That's what I wanted. I'd love to have 1 million people read it. You know, even if it's the same 20 books that get passed around, no problem.
So Brian, let's start real basic here. The Hacker Method. Hacker is an acronym. Why don't you just start there, go through each letter, and then we'll dive a little deeper.
Yeah, sure. Well, and how I came to that conclusion is when I finished my previous career. I was a CEO of a nonprofit. When I finished that, I was living overseas, moving back to the United States, and I was sitting down with a friend, and they were just asking me like, well, what are you going to do next? And I, spend some time with the family. I'm going to take a year off and this kind of stuff. No. What job are you going to do next? How are you going to pay the bills? And I was like, well, the bills are covered. You're not supposed to talk about money. And he basically started drilling into that, and just kind of forgetting all the social faux pas about talking about money. He was like, how much do you make? And what did you do? And how did you do this? And when he got all the way through the conversation, he looked at me and he says, "Do you think I could do what you did?" And I was like, "Absolutely. If I can do it, you can do it." And he said, "Would you show me?" And I was like, "Oh, well, I mean, sure." And then I kind of took away from that and had several other conversations similar to that. And I didn't really know how I did what I did. And so it forced me to sit down and kind of map out, what did I do? And like, here's these huge mistakes I made there, and this was a victory I had there, and what did I learn from that? And that is what emerged from that was a 5-step process that I essentially am taking and continue to take to build this real estate portfolio. And so I looked at like kind of what are the different steps, and I was trying to find words that fit. And we've already mentioned house hacking, and there was just so many things that we did in our lives. We hacked our lifestyle to be able to take a significant portion of our meager income and invest it. And so that's where hacker came from. And the hacker method stands for, the letter H stands for hack your lifestyle. So again, just so that everybody understands the context, I was running a nonprofit. For the first 3 years, we didn't make a single dime of W-2 income. And if you took our total income that we did make over the 16 years that we were doing that and divided it into the hours that my wife and I worked at the nonprofit, we made $9.20 an hour average, right?
Killing it.
So we had to hack our lifestyle. Like, we had to take a look at all the big expense items in our family budget in order to be able to save up for what we wanted to be our retirement, because we knew the nonprofit wasn't going to provide a big like golden parachute at the end or a big pension or anything like that. There was nothing. And so we lived on only 50% of our $9.20 an hour, and we invested 40%, and we gave away 10%. So the first step was hack your lifestyle. How to still live a dignified life, and in fact, a fun life, on less than what most people would consider to be normal. So house hacking is in there, the vehicle strategies in there, credit card strategies in there, a bunch of different strategies. The letter A is allocation budgeting. And so once you've kind of hacked your lifestyle and you've eliminated, like, I always like to say, it's get rid of the parts of the budget you don't want to pay, the car loan, the house loan, the credit card payments, get rid of that stuff out of your life, and then enhance the stuff you do like, the entertainment, the dining out, the clothing, the just the fun stuff, enhance those, and then invest 40%. So that's the allocation budgeting, 50, 40, 10 allocation system. And then CK is 1 step, 2 letters, 1 step, cash is king investing. So once you've hacked your lifestyle, you've allocated your budget, you've got 40% of your income that you're now allocating to investing. So the cash is king section is basically just giving you a high level overview of what investing is like. And kind of the punchline is in order for us to build wealth, especially on a meager income, we've got to have a mindset shift away from consumer and to investor. And so the cash is king section is really focusing on, how do I bring on that mindset, and how do I put on the goggles that recognizes opportunities that I can make investments, whether that's stocks and bonds or currencies or metals or real estate, whatever your jam is. You've got to kind of figure that out, build your buy box, build your criteria, and then execute. And then E, the letter E, is kind of a graduation from just the basics of investing to higher level investing, exponentiality. And I know that that's not a word, but it's just kind of this lifestyle of, I'm going to squeeze, like when you're making $9.20 an hour, you've got to squeeze every dime out of everything that you've got. And so exponential investing is anything from like infinite returns, where you invest a certain amount of money, at some point you pull out your original capital, leave the profits or the gains that you've got to multiply forever. That's an infinite return. Or like, you buy a house, sit on it for a while, your time is your asset, sit on it for a while, then you sell it and you upgrade to a duplex, then you upgrade to a fourplex, then you upgrade to a medium-sized multifamily, and your initial 10% down is now just like a little sliver because it keeps growing and multiplying. So just that kind of exponential growth mindset. So rather than dumping your investing money in a savings account or even a mutual fund, figuring out how to get those really great returns so you can see that hockey stick effect. And then the letter 4 is, it's actually 4 different letters or words starting with an R. So the first one is review. As with anything in your life, you've got to review what you're doing to see if it's still accomplishing the goals that you want to accomplish. And if it is, fantastic. The second word is repeat. So those of us who are investors, entrepreneurs, we have the shiny object syndrome where every time a new asset class comes along, like, ooh, self-storage, ooh, cryptocurrency, ooh, all these things that we know nothing about, but it's all the rage. And so we shift our focus and we go learn a bunch of new lessons in a new asset class. If after you reviewed your deal is working, you need to have the discipline to repeat what you're doing. If it's not, then you need to do the third R, which is rework it. You do need to pivot. You need to come to a new way to get those exponential returns that we talked about in step E. And then the final R, reward. I think that there's a trap and a tendency for people who get really good at investing to take 100% of their gains and roll it into the next investment. And I'm not saying that's necessarily a bad thing, but if what your goal is to find financial freedom through your investing, you've got to come to a point to where you're willing to reward yourself along the way. And so if we go back to the allocation budgeting 50-40-10 concept, if you were to sell, let's say you sell an asset and you make $100,000 gain, what I'm suggesting is you take 50,000 of that, 50% of that, and put it in your spending bucket. 40% of it, invest it, and 10% of it, give it away to make the world a better place. Because a 40% plug into your next investment, that's still a significant amount. But now you're starting to pile cash into your spending account to where that's going to get you further and further away from your dependence on and reliance on that W-2 paycheck. So that's the hacker method in just a couple minutes.
Man, you've been asked that question before. That's a great synopsis of taking a couple hundred pages and get it down in 3 minutes there.
Yeah.
So a couple of comments, we had David Green on recently talking about, the pillars of wealth, and it's the same concept of playing defense and having to save. Like, it's so easy. If you want to be in shape, it's like, okay, well, you need to eat these foods. You need to go exercise. Like, it's not complicated,
Right.
but no one wants to go do that. Like, no, I'd rather go have alcohol, have whatever. Like, it's easier to do that. It's nothing that's earth shattering here. It's just putting it out there. And the word you used so multiple times was discipline. Doing it over and over and over again and seeing these gradual returns that add up over time. And it's just it's so straightforward. And there's probably people nodding here be like, yeah, I know all this. It's like, well, no, you're not acting it. Like, you got to go do this. Do it and put it as part of your daily life.
So here's something that I want to walk through this with you based exactly on what you just said. So how many people, if we said, listen, I've got a briefcase stuffed with $2 million and the briefcase is yours, it's hidden somewhere in your city, I'm going to give you a map. It's going to be a little vague. You're going to take some wrong turns. You're going to make some mistakes, but you can find the briefcase. Here's the map. Do you accept the challenge? How many people would say no? I mean, that's like a reality television series that people sign up for by the thousands. How many people would say no to that? Now, what if I said, I'm going to give you that same briefcase stuffed with $2 million in cash, and I'm going to give you a roadmap to get there. It's going to be a little bit vague. You're going to take some wrong turns, but it's not across town. It's across a decade. Are you still interested? Because time is your asset. The only time you're going to get $2 million by walking across town is on a reality show. The reality is, if you want to have a briefcase stuffed with $2 million in cash, it just takes time. There's a few exceptions, like people who got lucky with crypto or people who win the lottery. But I mean, you might as well hope to get struck by lightning, okay? But if you actually want to build wealth, it's going to take time.
Yeah, that's great. That's a way better analogy than my workout one. Nice work.
Well, I've been tempted to use that one, but they use it on Bigger Pockets all the time. Like, I know what it takes to get a six-pack, but I don't do what it takes to get a six-pack, right? Yep. So
yeah, that's awesome. In the book you mentioned, just taking it one step further, if someone makes 55 grand a year, which in Chicago, like, barely, I don't know if you can even live off that, right? They'll earn $5 million over their lifetime. So why isn't that person retiring rich? Right? Like, that's a lot of money.
That's exactly the same question that I have. And I did the same math. Like, even if you make minimum wage in the United States and your salary goes up at the rate of inflation, which is typically what minimum wage does, you're going to make over $2.5 million in your lifetime. And that's on minimum wage.
You used an example in your book that I have not been able to shake for good reasons, but my family hates you for it probably, is the $100 dinner tonight which is not, I mean, you could get $100 almost at Chipotle these days. But that
Right.
$100 you
Right.
spent on dinner tonight eating out equals, I think if I remember correctly, it was like $3,200 20 years from now.
Yeah.
And if you're able to find a way to just eat something around the house, we always have something around the house. We always have a quesadilla we could eat. We always have a whole bunch of stuff in the freezer we could heat up. And
Yeah.
if you're able to take that and throw that $100 into something, or even if it's just bare minimum, like it's just crazy what that equals that we just spend every day.
Absolutely. Now, I'm very careful to say when I give that analogy is, so it's actually, I created this concept. It's not new math, but it's called the spin theorem. And you can actually go to my website, theunexpectedinvestor.com, and you can download it for free and you can run the math yourself. Like, I'm thinking about buying this car versus this car, and it's $8,000 more than the other car that I'm maybe not so crazy about. Plug that in, run the numbers, and it'll see what that cost is in the future. But I'm always really careful to say, don't run that formula on your spending bucket. You got to live a dignified life, right? So all I'm talking about is if you're ever tempted to do the extra night out or buy the extra pair of shoes or buy the super nice car that's outside of your budget, you need to run that number and see what it's worth to you in the future. And maybe you're fine with it. Maybe it's okay. I'm going to lose $100,000 20 years from now by having that nicer car, but maybe not, right? So having that knowledge might help you make a decision that's more forward thinking than just like, I want that right now.
Oh my gosh, we're gonna have to link to that calculator on our website. Like,
oh yeah, for sure.
I'm gonna have to play with that one. That's awesome.
So it's theunexpectedinvestor.com/calculators is where you go to download it.
Love it.
All right, so we'll link to that in the show notes.
Cool.
Brian, one of the things, regardless of what you're investing in, one of the things that stuck out to me is a quote: "Serious investors become professionals at getting around obstacles, especially the ones in your own head. Decide you'll do whatever it takes. Ensure your actions follow."
Yeah.
Right. Like, man, like, let's dive into that for a second. Like, that is just, it's such sound advice. And it's so, again, it's so, I don't want to use the word simple because that's knocking it, but like, it's just so straightforward. Just go do this, get out of your own head, you know, be able to take the punches and roll, and everything will work out.
Yeah. Recently I had a friend, a dear friend, tell me he's selling his house. I was like, oh, you're selling your house? Why? Well, we need to move into a bigger house. I want to be closer to work. You know, all that makes sense. And I said, what's your mortgage on that house? 2.75%. I was like, oh, wow.
Man.
and I sat there and I just like, I'm like shaking, you know, like, have you thought about maybe keeping that house and renting it out? Because I don't care what your mortgage is at 2.75, you're going to cash flow on that thing. And then just go buy what you want. You got plenty of money. Oh, no way. My grandma or somebody had a rental and they destroyed our carpet. And one guy one time punched a hole in the sheetrock. And I was like, okay, I know that I'm not going to get anywhere with this, but those are examples of things that go through our heads that, like, what, it's that hard to replace the carpet? What, it's that hard to patch the sheetrock? Again, here's a briefcase filled with $2 million. If you'll do this, this, and this, and this, which includes changing the carpet and patching the sheetrock, 10 years from now or 20 years from now, you've got a multi-million-dollar net worth. And so there's just all these things that come into our minds, from things we've heard from other people to things we've experienced ourselves to these fears that aren't even real, that cause us to stop and not take the steps that we need to take. Now, here's something else too that I like to tell people. There's a lot of people that make a lot of money on Wall Street that like to make investing sound way more sophisticated than you are. Guess what? Your job is probably harder than theirs. They're just doing math all day, okay? It's not that complicated. And if you can get out of your own head, like I don't know what the S&P 500 means, or I don't know what ARV means, or I don't know what, whatever it is that you think that this is big sophisticated thing. It's not. It's really, really simple. You just got to get it out of your own head, and you got to be willing to put up with some of the hassles, like changing out the carpet or patching the sheetrock, or honestly hiring somebody to change out the carpet and patch the sheetrock. You got to put up with some of those hassles in order to get the reward. I mean, that's just the nature of this world. So if you're not willing to put up with those hassles, and you're not willing to kind of look past some of the kind of the headaches that you're going to deal with, I mean, okay, fine, but you're just going to be stuck with golden handcuffs in your W-2 forever, and that's where it is.
Who not how? Who not how?
Yeah, find
Yeah.
someone to do it. But
Find your
it
who to
means
help
you're
the headache.
interested in this concept. You're not committed to it. There's a big difference, right? There's a
Absolutely.
difference between like I'm in, like I'm committed, I'm ready to get in the ring here, as opposed to everyone wants to be wealthy, right? Like everyone wants to. Like
Yeah.
who's are you gonna actually go take the punches here?
Yeah, exactly. Exactly right. Yeah. And I was tempted to try to offer to buy the house from him. And I mean, good night. Can I figure out how to keep this 2.75, but yeah. Because to me, for us, we see that like, oh my gosh, there's a pile of money sitting there. He'd probably cash flow $1,500, $2,000 a month just by flipping it to a traditional rental.
Well,
And he can clearly qualify for a new house.
I'm going to look forward to sharing this episode. So we manage about 1,500 doors for about 550 clients. And one problem we're going through right now is a tenant moves out and they always have a decision to renew or sell. And I have so many people that want to sell. And, selfishly for the company, obviously that's people that we lose out the back door, but I've literally been calling them and leaving them like video text so they can see the passion in my voice. Like, listen, I know you're only $100 upside down right now, but you see it, your rents went up $400 in the last few years. Give it a couple more years. You'll be positive. I can tell by the public records, you only owe this much now. And your interest rate's only please, like not even for me, you could go like, this is such a great episode and book that I'm going to refer to all of our clients because that people don't see that. They see, I got to do a $4,000 turnover and I got to deal with finding another tenant. I'm not sure how this tenant will be because the last one was great. I don't want to have someone worse. So that mindset is very restricting for people's long-term goals or opportunities.
Yeah, I don't know what your guys' theory is, but I really don't think we're ever going to see 3% mortgage rates again.
No.
And if we do, there's some massive calamity in the economy. And so there's other things to worry about. And so I always tell people, do whatever you can to keep that 3% mortgage, because if inflation is 3%, that is free money. And just keep that mortgage, cash flow it, figure out how to get a second mortgage or something so that you can unlock that equity, but keep that thing. Man, I just can't imagine. I mean, there's some scenarios where it just is inevitable, but I just always encourage people to keep those low mortgage properties.
I don't think we're ever going to see the low mortgage rates. And I don't think we're far off from never seeing $350,000 starter home price points either anywhere in the country.
Exactly.
So that's the other thing. So these small ranches, 900 square foot ranches, they don't even build anymore, are like the perfect rentals and will be $500,000 starter homes, no matter where you're at in the country. They're already, it's like that somewhere in California and stuff like that.
Yeah. Yep.
Well, it goes back to when you have responsible leverage on it as well too. It's like you're getting the appreciation on the whole shebang, even though you might only own 70% of it, right? Like where you can't get that anywhere else. Even if a stock like triple performs real estate, you will still make more on the real estate transaction because to get a $500,000 home, you might have only had to put 50 grand down at 10% down.
Exactly.
You're getting the gain on that whole 500 grand. You're not getting the gain on the 50. You're getting the gain on the whole damn thing. Now when things go down, right? Like it works both ways. But over the course of time, it's proven that as it goes up, that's the biggest bang for your buck. And if you're looking to increase your net worth using leverage in a responsible manner, like there's no better way there.
Yeah. So we can't know what's going to happen in the future. All we can do is we can look at what has happened in the past and make some assumptions that it's going to continue to perform similarly in the future. And I did some research, and the U.S. Census has actually recorded what the median home sale price was in the United States at each 10-year spot. So, and they started in 1940. And in 1940, it was like $2,700 was the median sale price, right? And then 1950, which between 1940 and 1950, we had World War II, we had the nuclear bombs, we had the end of the Great Depression, right? Then 50 to 60, 60 to 70, and all the way up to 2020. There wasn't a single decade. Now, it's not 1 year, but it's a decade where the median price across the whole country did not increase by at least 40% over those 10 years.
Say that again. That's crazy. Say it again. I just want to emphasize that home for the person driving that half-ass caught that.
Yeah, so somebody who is worried about investing in real estate. So from 1940, in the thick of the Great Depression and World War II, till 1950, and then 1950 to 1960, and every decade up until 2020, the U.S. Census has recorded at least a 40% increase in that median home sale price from the decade prior to the new decade. At least. And there were some decades where it was over 150% gain on real estate valuations. And if you look at that, it kind of tracks with inflation, right? So as long as we're going to continue to have inflation, we're going to continue to have home appreciation. And to your point a moment ago, if we have leverage on that, we're paying interest on the 80% of it or whatever, but we're getting the appreciation on 100% of it, but we only paid 20% of it. So it's like you're getting a fivefold of the appreciation rates versus like stock. I've had stock go to zero. I've never had real estate go to zero. I've had real estate dip and fluctuate, but it's never gone to zero, right? And so it's just one of those asset classes that history says that it is super, super stable.
That's great info. So one of the questions, and we get this a lot when we're at meetups, Brian, is people want to scale, right? They're bought into everything we've talked about over the last half hour here.
Yeah.
They're towing the line between being, well, I'll call it responsible, right? Like, hey, like, I don't want to spend my last dollar to get this 3 unit, but I want to scale. I see the value here. And it's tough, right? It's tough to even give that advice. Like, can you provide some either best practices or parameters for the person in that shoes where it's like, yeah, I want to scale. I want to every year drop another whatever into this. I also don't want to end up in a situation where, hey, I'm out of money.
Yeah. Yeah. So I had a mentor early on that told me you need to keep your portfolio at 50% debt to value. And then I had another mentor that told me you have way too much equity. You need to refinance all this stuff and double down and keep growing. And both of them have a point. Both right. And I listened to both of them. But I do try to keep my portfolio with a relatively low debt to value. And I just bank on paying down that debt and properties going up in value in order for me to continue to push forward. And I'm just always looking at those ratios. And when I've got a little bit of room, it's time to buy. I don't really care how. I'm just going to figure out a way, whether I'm going to get a line of credit or I'm going to use private money or I'm going to use a hard money loan until I can refi into something permanent. I make sure that I have all of my, protections in place and I don't violate my principles and my buy box and my rules. And as soon as I have a little bit of margin, it's time to get the next deal. And that's just how I function.
Got it. So it's still similar now. Like maybe it's not a deal a year, but you're still working on that same principle of, okay, it's now time to go get another one.
Well, so when I moved back from Brazil and moved back to the US in 2021, I had 17 units and my goal was to double in 2 years. And I did in about a year and a half, I grew to 35 units. And so my new goal is now to go from 35 to 90, and I'm giving myself 5 years to do that. And so I'm just making sure that I'm buying deep and I'm building equity. So that's how I'm scaling, is I'm forcing equity through a remodel and a reconfiguration of these properties, so that when I refi, I get most of my cash back out and I still have some equity sitting in there. So that's what I'm doing. I just got to figure out what your strategy is. And you got to have the guts, like kind of going back to that mindset thing. You got to have the guts that if you were comfortable with your buy box and your strategy a month ago, why are you not comfortable with it now? Was it flawed? Okay, fix it and then take action. You gotta take action and you gotta move forward. And you're never gonna be 100% sure, ever. Because we don't know what's going to happen in a month or 6 months or a year. We don't know what's going to happen. So you're never going to be sure. You've got to get to the point to where you're pretty sure, and then you got to take action.
You came back from your not-for-profit position and you stumbled, I say stumbled because I don't think you plan on it, into short-term rentals. Talk to us about how you kind of got into that on this side of your investment career.
Yeah, so that was actually before I actually retired from the nonprofit, but it was while I was doing that. So all of our property in Idaho, that's where I was from, that's where I built my portfolio, was rented out to long-term tenants, and we would still come back to the United States for a couple of weeks or a month or something each year to visit and raise money and all that kind of stuff. And we would always have to find a place to stay because even though I had a bunch of houses, they were all full. So we were borrowing a house from a friend, and we got home really late at night. It was like 1 o'clock in the morning. And we walked in the house and took a couple steps in and realized the house was flooded. And so we had to go to a hotel, and I've got a family of 5, and it just was uncomfortable. And the next morning, I was like, man, this is not going to work for 3 weeks or whatever it is until we go back. And my wife said, "Hey, why don't you try that? What's that new site? Air something." I was like, "Oh yeah, Airbnb." So I open up an account and I'm searching for 3-bedroom homes in Boise. It was September. There were only 3 options that had 3 bedrooms, and they were all somewhere around $200 a night. And after I got done like being grumpy about how expensive it was, I was like, wait, what am I getting per night in my houses? It's like $30 a night. So 2 months later, I converted a few units to test it into short-term rentals. It went so well. I moved them all to short-term rentals by the end of the year, and I haven't looked back. That was 2016.
So they're all, that's awesome. That's awesome. Now, what's your opinion on the short-term space long-term? Because this is a totally new like way of investing in the last decade. Like what do you see on the horizon? Because there's a lot of people that are basing their entire future on that idea.
Okay, so first of all, because I started with just kind of entry-level rentals, like that ranch home you're talking about, the 3-bed, 2-bath, 900 square foot, because that's what I had in my portfolio, that's what became my short-term rentals. And so I always knew in my mind, kind of going back to the 4 R's: review, repeat if it's working, rework it if it's not working. So if it stops working for some reason, I'm just going to go right back to traditional rentals. And I know that that works. It's slower. It doesn't make as much money. It's a lot calmer though. So there's that. Everything I buy, I make sure that I can underwrite it and I can convert it back to a traditional rental. And I always make sure that it's in a desirable area and it's the size and kind of home that other people will want to buy. So if I have to, I can sell. And I'm never like up to my eyeballs in leverage either. So I just make sure that I'm in a good position. So what do I think long term? It's hard to say. I guess my kind of theory is it was the wild, wild west for several years where anything went and there was no regulation. Now the governments are catching up to it. They're piling on a bunch of regulation, but honestly, I feel like that is going to like crest, and then we're just going to start coasting, and we know what the rules are, and this is what we got to deal with, and these are the markets we can't go to: New York, San Francisco. I don't know about Chicago. Does Chicago ban them?
Yeah, it's tough here.
It's tough here. Certain suburbs have banned it altogether. You can only do
Yeah.
midterm, and the people will shift to the 31-day strategy there. But yeah, no, the problem you're running with Chicago or the Chicago metro area is you have 186 suburbs that all have different rules. So
Yeah.
you just have to know them.
Yeah. So the key on that one is I would find out where it does work, and then you've got like a monopoly on the supply because it doesn't work anywhere else, right? So there could be opportunities if there are little pockets where it does work. But I think long term, I think the regulation thing will calm down, and we'll just learn what the rules are, and we'll keep going. I just don't see that it's a strategy that will go away entirely for sure. But if it does, I'll pivot.
Love it. So it sounds like sound traditional investing with the ability to turn it back to long-term as your backup plan. But at the same time, it's in a great area. If you had to sell it, you had to sell it, and you should be good because your leverage is low.
Yeah, I specifically avoid luxury short-term rentals, like the big monster cabin in the woods or the nice big beach house or the mansion in Scottsdale. I stay away from those because I just don't have very many options if short-term doesn't work out. Now I know people that are making a killing doing that, and I applaud them, and I'm thankful that they're able to do that. But I just personally, I try to stick with stuff, like I said, that can go back to a traditional rental, or I can dump it on the open market.
How'd you end up in Arizona? Was that part of your real estate strategy? Is that a family thing?
Yes, yes, and yes. So when we were coming back to the US, so I'm from Idaho, and the natural default would be to move back to Idaho. But we had lived in South America for 16 years. All my kids were born while we were living down there, and we haven't really experienced winter for 16 years. And so we wanted to go someplace warm. So we were looking at Texas, New Mexico, Arizona. And we spent a month in Phoenix in February, and we were like, okay, yeah, this is where we want to end up. Plus, I wanted to make sure we were going to a market where I would be excited about the real estate, and Phoenix was one of those. Like Austin was on the list at the time. Now it's kind of sketchy, but Phoenix was definitely on my list, so that was another factor as well.
Yeah, no, never experienced the winter. It's kind of funny. Like, there's people out there, like we have workers in Mexico. They never like we show them snow when it snows here. Like, so
I think depending on the order of episodes, I think the episode before this is the boiler blowing up in the middle of January. So
yeah, that's something like you can't even relate to.
Well, we have a lot of your Chicagoans that come down to Phoenix every year.
Yeah, you've had Portillo's.
Yeah, exactly. We just got one in Gilbert. Yeah.
Well, here, you know, a lot of people are listening to this, and I get this question all the time because, similar to your book, it's about, all right, let me start over here. So a lot of people listen to this say, all right, I'm going to take 50, have all my costs at my 50% ratio, and then the other 40 invest, and the other 10 give away or do something good with it. And there's a lot of people who are like, man, but you're not, you don't have, you don't have the kids I have, or you don't live in the suburb I live in. You don't have the wife I have. I mean, I married somebody that doesn't understand that, or, you know, how can these things apply, even partially to, some of those people that, you know, it sounds like you married your wife that was an equal to in this mindset, and you wouldn't be able to do a lot of these things. So what about those people out there that are maybe in different scenarios, but can still adapt to some of what you're saying?
Yeah, so my wife did not come from an entrepreneurial family at all. And so there's still stuff that I say or things that I think, and she's just baffled. Like, what are you talking about? Right. And so there has been a lot of discussion that we've had to get on the same page on this stuff. And early on, it was harder because it was just spend less. Now it's a lot easier because we're in the situation that we're in now. But so it wasn't easy. But I do say that it's really important for married couples specifically to be on the same page with this. And so I've started basically a mentorship community, a coaching community, and I always push. In fact, I want the spouse to be a part of the community so bad that their rate is just $10 a month, right? So because I want both of the people in there, I want them both hearing this stuff, I want them both talking about it, because that is key. That's essential. However, if you the three spending categories that can be eliminated are your mortgage. You don't have to pay a mortgage. You can house hack. And if somebody was like, I don't want to live in a duplex, I don't want to live in an apartment, fine. Find another property that you've got a main house and you've got an ADU, carve out a private yard for the ADU, additional dwelling unit, and rent out the ADU. And that's going to cover at least a portion of your mortgage. When we came back from the field during COVID, there was a stretch where we had to come back to the United States. I went and bought a house. It was in one of the nicest neighborhoods in Boise. I bought it at a good price because everybody was panicking, which is another lesson. When everybody's panicking, buy. When everybody's buying, sell. I bought this really nice house. It was a four bed, 2 bath, 2,500 square foot house built in 1938. Beautiful. And then it had a cottage on the back of the property that was a 2 bed, 2 bath cottage, also super cute. The one house has a door on Ellis Avenue. The other house has the door on 21st. So it's on a corner. The houses don't even have a door to the same street. Nobody would ever know that they're even on the same property. There's no privacy issue. There's no, I feel like I'm living in an apartment issue. And the rents that I get, I converted the cottage into 2 short-term rentals. The rents I generate from those pay the expenses on the entire property. So I could live for free in one of the nicest neighborhoods in Boise in a 2,500 square foot 4-bedroom house by house hacking. Never pay a mortgage again, right? And then the cars. You know, how many people have 2 brand new cars and have car payments on both of those cars? Go do the spin theorem calculation on what that vehicle is costing you 30 years from now, 20 years from now, 10 years from now. It's enormous. So I know it's not fun to like not buy the latest car, but I have a formula in my book called the logic formula. Don't do loans and leases, pay cash for your cars. Buy a car at 7 years old because that you've avoided the majority of the depreciation, but you're still not to the point where it's got massive repairs. Dump that car at 11 years because that's when the repairs start to come in, and just kind of all these different things. So if you can get your vehicle expenses down to just a couple $100 a month, you're saving a ton there. And then credit cards, don't carry credit card balances. In fact, convert your credit cards into income producers by doing my point printing process, which we don't have time to get into that today either. If you can get rid of those 3 categories, the average for most Americans is 40% of their income. And if you can save 40% on just those 3 categories, take that and invest it, and you'll be a multimillionaire within a matter of time.
And for those of you that are going to pick up this book, you'll get to hear what he was just talking about kind of hacking your way with points to go on vacation for next to nothing. So it was kind of interesting how you look at that. I actually shared those specific things with a couple of different people that I know would appreciate at least that.
Awesome.
Well, here, before we wrap up here, you have, we all have kids on this call. There's a lot of people on here that are at different stages. kids. You were raised in an entrepreneurial family. You obviously are creating that for your family. What are you doing with your kids to pass this on? What are you doing to any hacks on being a parent and teaching some of these things to them?
Yeah, it's such a great question. And I think this is where we as parents can have a massive impact. So let's even say that somebody says, yeah, my wife's not on board or my husband's not on board with the 50-40-10 budget. Put your kids on the 50-40-10 budget and make them and teach them to invest that 40%. They don't have any expenses. They don't need all the money they're getting for washing the car or cutting the lawn or whatever it is that they're getting money for, or even if they've got a job down at the local sandwich shop or whatever. Teach them the 50-40-10 budget and watch them build multiple tens of thousands of dollars in net worth. My daughter's going to graduate high school and she's got $25,000 in her just in her stock investing account. Plus she owns a little tiny sliver of one of my funds that I've put together. And, so she's going into college with this little baby rocket ship that's going to grow and grow and grow and grow. And I am teaching kids that when you go out and you get your own job and you got your own family, stick to the 50-40-10 budget, figure it out, do a house hack as your first purchase so that you're not burdened with that big, massive mortgage payment, pay cash for your cars. And man, they're going to be extremely wealthy if they can stick with that. So if you can teach your kids that, that's going to set them ahead, and maybe watching them multiply their wealth, even on a smaller scale, is going to influence you to want to do the same.
Great stuff, Brian. All right, so you're scaling your portfolio, you are building out this community for others. What else? I shouldn't say what else. That's a ton going on. Is there anything else on the horizon here that we need to talk about before we wrap?
Yeah. So we're doing that community. So all the 16 years I was working in a nonprofit, my heart was to serve, and when that ended, I kind of had this emptiness in my heart. I want to serve people. And so this is how now I am serving, helping people figure out the house hack. In fact, we're doing a 90-day coaching program. It's free for members of the Unexpected Investor community, where we're going to get on the phone twice a month and we're going to walk through the process. How do I go from where I'm at today, paying a $2,000 a month mortgage, to getting out of my mortgage by house hacking, and just walking through the process? Like, can you convert your existing home, or do you need to look for something else? And walking through that process. So we're always doing stuff like that, just to continue to serve. That's what I'm really focused on. We've got the book, growing the real estate portfolio. That's what we're up to.
And the book, we'll definitely link to that on the website and in the show notes. But the book, it was easy read. I mean, it wasn't short,
Thank
but
you.
it was easy. I literally read it from coming
You
from.
had to actually physically read it too. If Mark got through it reading it, it's
Yeah. I'm an audiobook guy, so I read it on a flight from Vegas back home, and it was great. So I knocked it out in
Awesome.
3.5 hours.
That's great to hear. That's awesome to hear. Thank you.
So all right, let's wrap.
All right, awesome.
Thank you, guys.
What are your competitive advantages? How have you been able to do this while so many others wish they could?
I think it definitely was an advantage to where I had my parents, my dad specifically, that exposed me to the understanding and the idea of investing in real estate. I definitely think that was an advantage that a lot of people just don't have, right? Maybe the entrepreneurial attitude that he had as well, that like, if I want to eat this month, I got to produce, kind of a thing. It's nobody's paying me a paycheck, kind of a thing. So I think that influenced me as well. Yeah, and then you're born with kind of some tendencies, and maybe that's helped out a little bit. But I think honestly the biggest thing was just having people that were speaking into my life that opened my eyes to what would be possible if we were to go down this route.
Yep. All right. What is the one piece of advice you would tell someone that is yet to buy their first property?
That they're just about to buy their first property. I would say the biggest two things. One, find a mentor who's done what you're doing before. Like, don't ask a guy that's done 100-unit apartment complexes if you're going to buy a single family home. Find somebody who's done the thing that you're doing, short-term rentals or whatever it is, and have them analyze your deal and ask them to critique it. Ask them to poke holes in it and show you why it's not going to work. And then number two, if that conversation ends with that mentor saying, yeah, you should do it, then do it. Don't second guess yourself anymore. Take the plunge. Even if it doesn't go perfectly, it's real estate, so it's probably going to go okay in the end, right?
All right. What do you do for fun?
I am a CrossFitter, so I punish myself for fun, I guess is the way you'd put that. I just love the competition. I love the class-based way to stay fit. And so I love that. We also travel. We have travel in our blood, and we love to travel. Just went to Dubai for the first time a couple months ago, and that was a lot of fun. So I would say that stay fit at the gym and travel.
All right. Give us you can't use your book. Give us either a good book, podcast, or self-development activity that you'd recommend to our listeners.
Well, this podcast obviously is the
Woo!
best. Um, I've really enjoyed listening to the All In podcast. You guys
Yep.
familiar with those guys? So, and part of the reason is because I don't understand half of the things they say. And so I feel like, one of my principles is I always want to be in a room with people who are further ahead than me. And those guys they're all billionaires or close to it, and they've done venture capital, and they talk about different ideas of syndicating investments. And so I'm just trying to learn from them and their fascinating crew. So I like that. A book that I would recommend, it's a really old book, and this would be for people who are in charge of teams, is the 21 Irrefutable Laws of Leadership by John Maxwell. Everything now is like the one thing you do or the three things max, and his is the 21 things. And I can't remember all the 21 things, but just his advice is just really solid. It kind of helps pinpoint areas where you're weak in your leadership. So that's what I would say to those.
I think that is one of John Maxwell's best books. Like, I think
I
like
agree.
for no matter what stage, even if you're not leading people, like, I don't know, it's a
Yeah.
real book. All right. Besides yourself, name one person in your network you'd highly recommend to other investors as a quality resource.
Oh wow, good question. There's so many gurus out there that I would just like not recommend, right? But
that part's easy.
yeah, that's easy. So I mean, you guys just had David Green on. I think David's got his head squarely on his shoulders. I met him in GoBundance as well. And Brandon Turner, I think he's a great guy. He's still young, but boy, he has accomplished so much, and he's got a great style for communicating, and so he's able to communicate things in a way that helps people make sense. So I think Brandon is a stand-up guy as well. David as well.
I'm going to send him this. I'm going to send him that clip because I tried getting him on for episode 200, like to have a big, like 200 episode. And he rejected us or he said no, because whatever his time he was leaving bigger pockets. So maybe we got to get him for 300 using that clip right there.
There we go.
Get him on. He'd be a great guest to have, and tell him that David came on. What's wrong with you?
Yeah, no, for sure. We got guilt, whatever. I'm not no shame in how we get him on.
We are not above any of this. So we're from Chicago. We'll slide some bills.
There you go.
All right, Brian, thank you so much.
Past obstacles right there. That's what I'm talking
about. Thank you so much. You provide a ton of value to our listeners. How can they learn more about you? Is there any way they can provide value to you?
Yeah. So, you can get the book. It's on Amazon and Barnes & Noble and Target.com, Walmart.com, everywhere you can buy a book online. And I hope that actually helps you. And if you buy it and you pass it on to 4 people, that's fantastic. You can find me at my website, theunexpectedinvestor.com. And if you're interested in that community we were talking about, it's just theunexpectedinvestor.com/community. And it's only $97 a month. And you come in and we're talking about real estate investing. We're talking about charitable giving. We're talking about how to elevate the relationships of the people that are in our lives, all that, and just working with people where they're at, what's your goal and how do we get there, right? And then on social media, you can follow me there as well at Unexpected Investor on all the platforms.
All right, it's good stuff. Now we end the show with the Chicago Fact. So Mark's going to tell us who we're playing for, who's sponsoring, and then you guys will both get a crack at this.
All right, we're playing for TJ Flores, who, we pick people's names out of the hat that do different things that benefit the podcast. And TJ actually left us a review. I pulled his name this morning. He left his review like 2 years ago on iTunes. So TJ, if myself,
get back to the OGs. I appreciate that.
TJ, if myself or Brian gets this question right, you'll get a $50 gift card brought to you by Josh Tegelman and State Farm and insurance coverage. So
awesome.
Very good. I just renewed with them. They have very competitive rates on the full rehabs, guys. Make sure you're reaching out to them. All right. So you'll get multiple choice here.
Okay.
So in what year did the iconic Sears Tower officially become the tallest building in the world, surpassing the height of the former World Trade Center towers in New York? And your options are
okay.
Your options are 1958, 1966, 1973, 1979.
1979 is my answer.
I would have said 79 too, but I'll say 73 so we can hedge the win.
There you go. Way to strategize there. 73 is the answer.
All right. Yeah, I knew it.
Wow.
All right. I love when you don't have local guests on. You ask very touristy type questions. That was a very touristy one.
And he came in ready to roll there. That was a very confident answer.
No, I love it. All right, that's awesome, man. So Brian, we just got a $50 gift card for TJ, brought to you by Josh Stegelman and State Farm Insurance. So
super fun. Good deal.
Man, what an awesome episode. You have an awesome book. I look forward to sharing this. I look forward to link everything here on the homepage of straightupchicagoinvestor.com. But thanks for coming on, man. And I look forward to networking with you more within Go Abundance. We didn't even get a chance to talk about what that's done for you, but
absolutely.
Thanks for coming on. Tom, thank you. Listeners, go to straightupchicagoinvestor.com. We're going to have links right on the homepage to get Brian's book and also to his, what's that calculator about? I got a link to that as well too. So
oh boy, the name is escaping me right now.
We're going to link to that. We're going to link to your mastermind.
The spin theorem, because it's the first two letters of spending and the first two letters of investing.
All
right. You need to spin away from spending, go to investing. I'm going
to share with my kid as well too tonight. My kids tonight. So, all right, man.
Yeah.
Tom, thank you as always. Brian, thank you. Listeners, we'll see you next week.
Thank you, guys. Appreciate it.